to briefly introduce our presenters here before I turn it over to them to start our dialogue. So again, thanks again to LexisNexis Risk Solutions for hosting this session, and really appreciate the expertise that you'll be hearing from. They are joining us on the line on audio, not visual, so if you're just seeing me and you're wondering where everyone is, don't worry, they're there, and you will be able to hear from them, which is the most important thing. So I would like to welcome, or welcome back as the case may be, Chris Siddons. He's the Senior Director of Market Planning in the financial crime compliance area of LexisNexis Risk Solutions. He's joined by his colleague Daniel Poehler, who is the Director of Market Planning with LexisNexis Risk Solutions. Also joined by Joe Cataldo, Managing Partner of Psionic, and Bishi Nayak, who is a Director at Psionic. So we're thrilled to have all of you here. With that, I'm going to turn it over to you and let you get us started. So thanks again for being here. This is a critically important topic that's generated tremendous interest from the audience, and I'm sure they're eager to hear what you have to say. So go ahead and take us away. Thank you.
Thank you. I appreciate the opportunity to speak today. A couple of housekeeping items as we go through this. When we talk about effectiveness today, we're going to be talking about effectiveness both at a national level, and we're going to be talking about effectiveness at an institutional level and how those two objectives sometimes are aligned and how those two objectives are sometimes misaligned. But today, at this first part, we're going to talk about effectiveness in the context of what are we trying to do as an AML regime nationally. And so with that said, we start in measuring effectiveness with understanding, well, why are we doing what we're doing? And the reality is the AML Act doesn't really define a lot of new stuff. What it does do is it tends to codify the purposes and the things that, at least in the regulated financial industry, primarily banks and money services businesses, have been the objectives and purposes all along. It's been the outcome we've been striving to achieve. And so the focus of those objectives has always been report highly useful information to law enforcement and the intelligence and counterintelligence functions within our government, and strive to provide them the information necessary to prevent money laundering, prevent terrorist financing, enable the tracking of money, safeguarding the financial system, and sharing information between financial institutions and between financial institutions and law enforcement to achieve those goals. And I would argue, just as a baseline, that the AML regime in its natural state, we're coming up on 20 years after the U.S. Patriot Act was published and passed. We've actually done a great job of achieving our goals. We haven't had another 9/11. We've had countless instances where the information that the financial industry that has provided to law enforcement has gone to the prevention of horrifying things in the country and internationally as well. So I would argue that we're generally striving for the effectiveness of these outcomes. We're generally achieving these at a baseline level. And so in this next question, I want you to think about are we achieving these objectives at a national level, and are we achieving these objectives effectively? So Brian, if you would, I think the next one here is a polling question, and I'll hand this back over to you.
Great, thank you. Yeah, so there's a polling question up on the screen now, and the question is, which AML objectives do you believe are most effectively achieved? So in the current way you are operating, what are we doing well? Is it reporting highly useful information, preventing money laundering and terrorist financing? Is it tracking the funds? Is it safeguarding the financial system? Is it sharing information with, for example, law enforcement and the public sector? So you can choose all that apply. This should be up in your slide window currently where you're viewing the rest of the slides. There's boxes. Check whichever boxes apply to you. and how you think you're doing currently, or how we kind of writ large think we're doing. And go ahead and let's get some responses in at this point. And just another reminder, please ask questions throughout the session. If you joined after the intro, you'll see a Q&A box underneath the video window where I'm currently hanging out, or it might be under your slide window, depending on how you've configured your console or it looks on your end. But look around for a Q&A box and type your questions into that Q&A box, and we will be fielding questions throughout the presentation. This is one of several polling questions we'll be doing, so also be on the lookout for these throughout the session. All right, we have good responses so far out of over 700. Some of you here, almost half you have answered. So we'll let this run for just a few more seconds before we flip over to the poll results. So let's see if we can get up to 50% of responses here. So last chance, submit now or forever hold your peace. We're at 48. All right, great. We just snuck in with the 50%, and now we're going to jump into responses.
Fantastic. Okay, so yeah, pretty evenly divided across the population. I don't think that's unexpected, and then I would argue that's probably a pretty representative sample of the population attending the session today. I think this is a pretty good outcome, pretty expected outcome. Well, let's talk about the things that kind of go into achieving the effectiveness. And I think there are some challenges that we've experienced over time. Brian, I think I'm ready to move this forward if I can.
Yep, go ahead.
Thank you. So as we kind of think about those results, I think we'd overarchingly agree that we're doing much of the program well. We're achieving national priorities. And I think over the last 20 years, just in my historical experience, I remember being pre-Patriot Act outside the country, being subject to the scrutiny of the FATF mutual evaluations and the full spotlight of the U.S., U.K., and other developed countries demonizing the offshore territories and the financial systems there. And what's interesting is, as I returned to the U.S. and as we began implementing the Patriot Act here after 9/11, it was interesting to see the challenges that developed. For the most part, I think we're reasonably designed programs to give information that's useful to law enforcement, track money, safeguard the financial system, and I think we've seen that outcome. But what's interesting and what has been evidenced over the course of time, and I think we're overarchingly getting better at it, is the individual actors. And as the execution of what's a reasonably designed legislative framework and a reasonably designed risk-based AML program begin to develop and the actors begin executing within that framework, we start seeing the development of behaviors down to the institutional level. And so the team's going to talk here in a while about some of these metrics, but safeguarding the financial institution begins to become the priority at the financial institution level. It's not about the banking system anymore. It's about me, the bank. And Dan, I think you have some thoughts around this that I'd like you to share, because I think there's some great examples in more recent history that kind of illustrate these principles.
Yeah, Chris. I think I wanted just to take a second and talk about customer friction being a really important point. If we take it a step further and talk about de-risking, right? So I was thinking of an example where if I own an MSB, a money service business, and I've registered it with FinCEN, and I'm not really breaking any laws, but my business has been de-risked from my bank, really because the bank wants no part of banking MSBs. Right? How is that effective? And we may see an extension of this with the AML Act of 2020 as it relates to art and antiquities dealers. But just wondering if you had any thoughts, Chris, maybe on the friction from the perspective of de-risking.
Thanks, Dan. I had to unmute my mic. So I do have some thoughts on de-risking, and I think de-risking actually covers not just friction, but it actually expands into all four of these categories. And so from a customer friction perspective, I think here's the natural tension if you think about high-risk businesses like a banking, a money services business, or, I guess the flavor of today would be more, marijuana businesses or something like that, where they're kind of, for all intents and purposes, they're high risk. That's fine, but somewhat demonized in the regime. And ultimately, the kind of the story goes like this: I have to do a lot of due diligence. I have to spend a lot of man hours. It's painful for my customer, and ultimately, it's very costly. And I create that friction and I create that cost because I need to make sure that I'm complying with all of the different variables that I have to comply with in order to demonstrate compliance to the regulators. And so if I'm a bank executive and I'm looking at this business from purely a capitalist perspective, I'm not looking at the public good that an AML program does. I'm thinking about my business. I've got an obligation to my shareholders. I've got an obligation to my board. I've got an obligation to my employees not to lose money. And then at the end of the day, I'm faced with a decision. And it's purely a commercial choice. And that commercial choice is, do I bank this customer at a loss for the sake of the economy? Because my goals, part of my mission as a financial institution is to drive economic growth through the lending of money based on deposits and increase the money supply, so on and so forth. But at the end of the day, I'm managing my bank. And I've got a capital allocation question to answer here. And so I answer it, and I de-risk. And in the process of de-risking for profit and commercial reasons, the reality is we're actually driving high-risk businesses to less safe, less robust control environments where there is an opportunity to abuse them, and there is an opportunity to leverage those non-core bank financial systems for illicit purposes. And so when we begin to act in a stakeholder silo, we begin to drift away from the objectives of the AML program. And I'm not suggesting that people made bad decisions or wrong choices. What I'm saying is it's a natural, logical path given the variables and the levers that are available for each group of actors, a banker, a regulator, FinCEN, law enforcement, for each one of these to make. And so I think as everybody goes through the conversation today, it's, keep this in mind as an audience. We're sitting in a particular seat, and ultimately we have a set of behaviors that we're driving towards. And the question is, are we actually driving behaviors that are striving to achieve safety and soundness for the bank, safety and soundness in the financial system, and are we achieving the objectives of the AML Act? And that's what it's really there to drive as far as the enhancements that are outlined in this particular piece of legislation. So I think it's time to move forward here. I think the team's got some things to really talk about. Joe, we're going to hand over to you around explaining what's in the Act and what's to come here. And so off you go.
Yeah, thank you, Chris. So again, this is Joe Cataldo from Psionic, and I'm going to take you through a couple slides around what's actually inside the Act itself and some of the FinCEN rulemaking associated with the Act. Just quickly to mention that if you've heard the Psionic LexisNexis shows in the past, we've done a number of these in the past. This is the only section that is a little bit of a rehash. What we've done is taken the last presentations that we did, which really drilled into the Act and the changes and condensed it into this section that I'm about to present here. So please bear with us if you've seen this before. We're going to get into some new and interesting stuff with Dan and Bishi in a couple of slides. So with that said, and before I advance the slide, just to kind of put the context out there and kind of summarize a little bit of what Chris said, one of the key goals of the Act was to reaffirm and make quite explicit in the law and codify in the law the risk-based approach that has become part of all of our lives and is really the de facto standard for how all of us do our jobs day to day. right? And you'll see this not only in the Act, but also reflected very, very clearly in the FinCEN Advance Notice of Public Rulemaking that really reflects specifically, how they expect the changes to be implemented. Those rules were published in September, or the Advance Notice was published in September of last year, and the comments were due by November. Interestingly enough, that was before the Act was actually signed into law, which, although it's called the Act of 2020, probably all of you know that it was actually signed in January of this year. But nonetheless, the rulemaking really reflected full knowledge of what was going through Congress at the time. And the interesting thing as you read through that is it probably spends about 5 pages going through the history from the BSA Act in 1970 being enacted in Congress through to today, where we have, very much a risk-based approach to AML as the de facto standard. And that's because there's a clear acknowledgement by FinCEN and by the regulators that one size does not fit all, that a retail bank is different from a correspondent bank, that a private wealth firm is different from a corporate banking organization, and so the controls need to be different. And what the Act tries to do, and I think does a fairly good job of, is clarify and formalize those changes. So with that context, let me move on to the next slide, where I want to highlight one thing that I think really speaks to kind of the theme throughout this presentation. There was ambiguity up until the Act was enacted as to what does reasonably designed mean, and I think many of us have struggled with that ambiguity. And I think there's a nice clarification that comes out of this in the law itself, right? So does reasonably designed mean to comply with the AML Act, and the BSA Act and the entire legal regime, or does it mean reasonably designed to detect and interdict money laundering and financing of terrorism? And the Act makes it explicit and clear that we are being held to a higher bar, that reasonably designed means that it is designed to detect and prevent money laundering and terrorism. And the reason I wanted to highlight this is this change, I think, speaks to me personally, and I think it will speak to all of you as well, right? Because we are, I think, most of us very passionate about our jobs, right? I'm proud when someone asks me, what do I do? We help fight financial crime. We help law enforcement stop truly bad actors from doing truly bad things, right? And we make the world a better place. And that passion, I think, is something that I think, we can look at the changes that Congress has enacted and the rules that are coming out of FinCEN as kind of an affirmation that this job is not about checking boxes. This job is about really making and doing things that change the way law enforcement can actually interdict criminal activity. So let me advance the slides. So another interesting and I think important part of the law is it defines and again codifies what is a risk-based program. Now, if you look at the language in the law around this, you're not going to see a lot new. I think if any of us were asked, what does risk-based programs look like, I think most of us would come up with much of the similar language that you see in the law. But what I highlight here is something that I think is really important, and we're going to reflect on this as we go through the subsequent slides from Chris and Bishi and Dan, that the language, if you look at the very end of this that's taken directly from the law, right, it says that you're able to reallocate resources from low-risk activities to higher-risk activities. And that's really important. And this is something that has never been explicit until now. Right? The law is acknowledging that we are able, as an industry, to reallocate our focus from lower-risk activities to higher risks. And you'll see in the FinCEN rulemaking that I'll go to in a couple seconds, the rulemaking actually echoes all of this. Another item that actually is I think of concern to many of us is this language that you see here around potentially reshoring. And this has kind of raised a lot of concerns around some of the, especially the larger FIs in the industry. I'll say a couple words about this just to kind of maybe allay some concerns. One, this language was added relatively late in the process, and it wasn't clear what Congress's intent was. And FinCEN has been completely silent so far on what the execution of this in the rulemaking will look like. But there is this risk that those of us who have financial crime programs, AML programs that use offshore resources will need to start thinking about reshoring. The other thing, if you look at the kind of language, and this is why I put a quote around remain performed by persons in the United States, right? That word remain kind of implies no change, right? So it's something to basically keep an eye on and be very cognizant of if you do have offshore resources doing your AML programs. The next thing I want to highlight is some new functions that are being implemented as part of the Act, right? So there's this organization, the Office of Domestic Liaison, and the Foreign Financial Intelligence Unit Liaison. And basically here the theme is to improve coordination and to create greater transparency between law enforcement and all of us in the industry. The other thing is it sets the responsibility to Treasury around setting national priorities around counteracting money laundering and financing of terrorism. And you'll see now next in the FinCEN rulemaking that needs to be reflected in all of our programs. So I will advance the slide, and I think, Chris, next slide is yours to talk a little bit about model risk management. Chris, maybe you're on mute.
Good. Thank you, Joe. I was talking away. So the model risk management requirements within the AML Act are pretty much summarized here, but ultimately what the AML Act is going for is a better framework for using innovative technology. It's really around promulgating standards around technology processes, and the rationale for this is really focused on kind of the historical experience. We have guidance. The model risk management guidance is great. I think if you deconstruct that in an AML environment, we'd all make arguments as to how much is effective, how much is necessary. But what it's really driving for is ensuring that all the financial institutions, all the people using transaction monitoring systems, sanction screening, adverse media screening systems are painfully aware that they're plugging those things into an ecosystem. And the ecosystem is a technology ecosystem of data flows that have human input at the front line in a website as people are opening account and inputting payment data. And an acknowledgement that that data goes across, 1, 5, 10, 50 hops before it ever ends up within a screening system or a transaction monitoring system. And so it's highly likely, and we've seen, across the last 20 years, innumerable instances where, Daniel Polar became Paniel Dolar, right? Just simply because something got cockeyed in the data flow from point A to point Z. And so it begins to degrade the effectiveness of the tools. And that's really what they're going for. And it really is just codifying practices, or should just be codifying practices that are already existing in regulated financial institutions today. Now, I will say this, people who are not banks, so money services businesses, payment system operators, and, I would argue that, those institutions have a different set of strengths and a different set of skills and are probably, adept at managing those same things. But sometimes the documentation may not be fully fleshed out. And I think, Dan constantly brings up this example of, new AML people come into an organization and they've got no documentation to draw from. And really model risk management is saying, look, don't leave the next guy to document your ecosystem. You've all seen the high school biology diagram of, the water, the body of water, the trees, the land, the shrubs, the aquatic animals, plants. That's really all this is going after. And it's codifying it really to just make sure that everybody understands the way that they're looking at the technology environment and making sure that good, sound internal control processes and technology are not divorced from the compliance program. That's really its objective. So it's relatively innocuous. It's just painfully expensive to implement and takes a lot of time and effort to really think through your ecosystem within a financial institution. So with that, Joe, I'll kind of hand back to you.
Well, so hang on, Chris. I just wanted to point out one thing real quick, if we could. As Joe pointed out before, and this is Dan Polar, we've done this a couple of other webinars, and we had a lot of questions about model risk management. We've condensed it sort of into one slide, but there really are two themes. Chris just touched on one that we get asked quite a bit. The first was what Chris just pointed out, the sitting compliance team really didn't have anything to do with the screening engine or how it's set up. So Chris has addressed that. There's a second question that we get asked quite a bit that I think would be helpful, Chris, and it's really more dealing with COVID, right? So the question is really during the COVID pandemic and the working environment that it's created, compliance staffing levels may be stretched really thin. At the same time, a lot of the banks have been operating under extreme service level pressures, really that could be attributed to things like the PPP loan cycles that we've seen. So as it relates to model risk management, that new normal and it's really like new service levels that they haven't seen before, how should compliance teams adjust to that new normal as it relates to model risk management?
Dan, I think that's a great point. And whenever I've kind of sat in that seat and new things like that pop up, and inevitably we have fire drills, right? I mean, the life of a compliance practitioner is really more like a kid with ADHD. We're constantly being distracted from the core objective by new things that pop up unexpectedly and unpredictably. And that's a great example. And inevitably, kind of there's a thought process I go through in kind of looking at these programs, and that is, what's my existing internal control framework? Is that new requirement leveraging existing platforms and systems, or is it just so outside the box? We're going to address one of the questions here later on about Bitcoin, but PPP, things like that, those should be using existing systems, underwriting practices, processes. They aren't entirely divorced from the framework. And so my first triage in that is, what can we do leveraging existing controls? What can we do to mitigate those gaps in real time where existing controls might not be addressing the particular risk posed by that new thing? And then, in PPP world, it's really fraud triage, right? I don't want to lend money to people who aren't who they say they are and don't deserve the funds because they don't meet the true criteria. That's line of defense one. Line of defense two is, after all that dust is settling, from an AML perspective, are there other things that I'm going to have to put in place now to kind of deconstruct? Are there additional money laundering or other cases that come out of this that I need to be reporting on? And that's generally how I focus on that. Joe, do you have anything like to add to that?
Yeah, and just a point, on the model risk management piece, right? I think, again, whoever is from the New York side or the part of the New York DFS, you all know that there is a lot more stringent requirement around the model governance process as well as the documentation and all from the DFS 504 side. And there is a thought process that the whole AML Act 2020 may require this DFS 504 standard to become standard across the U.S. It will not be a matter of just the New York-based financial institutions. There is a potential chance that it become a standard that is required by all financial institutions across the U.S. as well.
Yeah, I guess the only thing I'd add is that, just to not scare everyone to death, there is a clear expectation from the regulators that the model risk management and model validation and model governance processes be fit for purpose. So, I mean, if you're a small institution that has, largely manual processes, there's a much less, a lower bar, I guess I would say, to the model governance processes than if you're a multinational bank that has, many, many different data sources coming into your transaction monitoring systems with very complex operational procedures and very complex resolution procedures to get to the point where you might or might not file a SAR, right? It's that latter case where there's significant risk that one data supplier or one data issue can cause significant downstream impacts to the quality of the output, right? So that's where you need much more robust programs, whereas in a smaller institution with less complex infrastructure, model risk management doesn't need to be nearly as robust.
Well, we've got a question on this topic that just popped up. I think it's a great one. I'd like to fit in here real quick. And in light of the recent SAR breach, does it make sense to compel disclosure of proprietary configurations and algorithms? And I think the reality is it's a wonderful question. And as a data and technology vendor, it's one that's very near and dear to our heart because the implication there is both deep and severe for intellectual property protection and rights. I think, is it fair? Is it good? Those are some interesting opinions that we can debate, but is it necessary? I think the reality is there's an element of people like to call it black box. I think most black boxes are not as black box as you think. If you put certain behaviors in and you kind of think through the variations of data, excuse me, you think through the variations of data and the testing that you can do to poke and prod and see how that quote unquote black box operates, very quickly the darkness of the box becomes much more exposed and it becomes a much more opaque as opposed to completely completely untransparent type of model, particularly from a vendor's model perspective. But I think there's a big risk. I think at the end of the day, intellectual property protection is a big risk in disclosing proprietary information in that forum. And it's going to be interesting to see how FinCEN and the regulators would propose to protect proprietary data like that. So, Joe, in the interest of time, I think we've got to kind of move on here. I'll hand back to you around national priorities, and then there's a question during the polling question that we're going to want you to weigh in on as well.
Okay. So the next slide here just talks a little bit about how the FinCEN Advance Notice of Public Rulemaking is now reflecting what we went over in the last few slides around the Act itself. And basically what you're seeing here is that the FinCEN rulemaking, not surprisingly, is echoing a lot of the priorities set into law. So, I mean, let's just look at some of those items, right? So first, there's a definition of what is an effective and reasonably designed, right? So this is something that always was left up to all of us to kind of figure out what that means. It's nice that now we're getting a little bit more explicit, but I mean, I think also it's not something that is terribly shocking in terms of what you read here, right? I think if any of us were asked to write what do we think is an effective program or a reasonably designed program, much of what we would write, I think, would be reflected in the rulemaking that you're seeing from FinCEN. I'll highlight this last item, which is useful, right? That is an important aspect of the law and an important aspect of the rulemaking that's coming out of FinCEN. This focus on the information that we're reporting back to the regulators being useful. And that's only something that is a bar we can all shoot for if there is feedback. And that gets back to the points I made in the earlier slides about these new organizations and this expectation in the law that Treasury is setting priorities and providing feedback to all of us about what information actually is useful, what is being done with what we submit, and how can we do a better job of giving law enforcement useful and effective and actionable information. The other interesting and important thing I think that everyone should be aware of is it makes explicit the requirement for a risk assessment. Now, Psionic does quite a bit of these and work in this area for a number of financial institutions. It is exceptionally rare that we come to a bank that does not already have a risk assessment in place. So it's become, again, something that is a de facto standard for most of us. But it's worth noting that now it is an explicit standard. So when the regulators come, they'll be asking you for your risk assessment, and you better have it ready and available for them. And your program obviously should therefore reflect what the risk assessment says, right? They cannot be disconnected. The expectation will be that that risk assessment then drives the priorities and programs and policies that you implement. It again talks about this set of Treasury national priorities and explicitly says that you shall keep those Treasury national priorities in mind in the designing of your effective program, right? Again, what is useful, what is effective from a law enforcement perspective? Well, Treasury is publishing that and now is telling us what they feel is useful, what they feel are their priorities from a law enforcement perspective, and now we all need to keep that in mind as we design our programs. And again, I'll reiterate it because it's really important, and I think a lot of the next slides reflect this. Effective means reallocating resources from areas of lower risk to areas of higher risk and higher priority. This is explicitly mentioned in the FinCEN rulemaking, and again, I think that that's a positive change for all of us. So that is about that slide. So I'll quickly, I don't want to drain the slide because I think we're starting to go long, but what's coming and what are the alignment to national priorities about? So I think we all do the red flag mapping, and now again, the Treasury priorities need to be reflected in that red flag mapping as well. AI and machine learning is an area of interest and excitement. Psionic is seeing a lot of big uptick in interest from our clients in this area, exciting area, and the regulators are starting to respond. FinCEN has put some rulemaking out that encourages institutions to invest in AI and machine learning. It's asked for all of us to come back with comments. That wave is coming, and I think it's a wave for positive change, right? Because the level of noise, the level of non-productive alerts and issues that we all spend so much of our days reviewing, if we can make that more effective, if we can have more high priority, highly effective, issues that we're looking at, and I think that'll be just a positive change for all of us. And AI and machine learning has the potential to make that kind of change. We didn't mention much about the Corporate Transparency Act. That is a big part of what the law has in its language. That's because it really doesn't have a big impact on the financial institutions, right? The impact is really to the folks who are registering themselves, and the financial institutions are not reporting entities according to the CTA. So it's just worth mentioning that why haven't we mentioned much about the CTA? That's the reason. You'll see some of the other things that are coming out of the future section, right? So FinCEN has asked for feedback, but it's coming that virtual assets are going to be classified as currency, right? So that is the December rulemaking that came out of, or advanced proposed rulemaking that came out of FinCEN in December of last year. Basically proposes that virtual currency be classified as a monetary instrument. And that's something that I think we all need to start getting ready for, because that's coming. And again, I think that this is something that most of us were probably considering that as a de facto standard anyway. Another just quick point, and then I'll move on, is the CTR and SAR thresholds. Those haven't been updated since 1986, believe it or not, right? And so those values are going to be updated. That's actually in the law that Treasury is going to be releasing, is asked to release new thresholds. So hopefully we'll get less noise and annoyance filings and more kind of focused on risk filings. So let me advance the slide, and I think there's a polling question next. So I'll turn it over to you, Brian, to take us through that polling question.
Great. Yeah, just in the interest of time, we'll do this one pretty quickly, and we'll throw a question out from the audience while we wait for some responses to come in. But again, this should be appearing right there in your slide window. Go ahead and choose the answer here. Do you believe publishing and aligning national AML priorities will make managing AML programs easier or more difficult? And I do see a question about what the timeline is for that. When are the strategic AML priorities expected to be published by Treasury? I believe in the legislation it directs them to publish them annually, but I don't know that there's a specific date given there. But I'd welcome if any of our presenters have intel on that. I'd welcome any thoughts. There was also an interesting question around the regulators and the examination process. We talked about reasonably designed, and one of our attendees is wondering, how do you anticipate the regulators will impact the examination with the clarification of reasonably designed that we discussed earlier? So how does this kind of play out in the examination? I'd welcome, Joe, any thoughts from you on that, or anyone else that wants to chime in while we're waiting for some poll responses.
Yeah, sure. Maybe I'll take the reasonably designed question, and then we can, maybe Chris, you had a slide actually in the last one of these sessions we did around the timing, so maybe you can address that one. So on the, what are the changes we're expecting from the regulators? I mean, so I think first, we're absolutely expecting changes from the regulators. That is something that, as Chris mentioned in his slides, if there aren't changes in the way the regulators are behaving, then this regime doesn't have a meaningful impact on all of us and how we do our day-to-day business, right? So, I mean, some of the things we talked about already in the slides, right? So there'll be an explicit now ask for the risk assessment. Most of the time, all of us are being asked for that already, but now I think you need to get your act a lot, it needs to be a tighter thought process around the risk assessment now that it's an explicit one. They'll be asking about the national priorities and how your program aligns to national priorities. So you need to keep those in mind, and you need to be driving your program around some of those national priorities if they're relevant to the way you do business. They'll be supposedly giving us feedback around usefulness. Now, there's not a lot of details around how that feedback is going to happen beyond the creation of these new organizations within the Treasury, but they'll be giving us feedback on usefulness, and that I think is a good change for all of us, because it'll be nice to know that this is not going into a black hole, that we're actually doing things that are useful, and we can fine-tune then and react to that feedback with making our programs more effective. And I guess the final thing I'll say on that one is that they'll be open to the idea of reallocating resources away from low-risk activities and towards higher-risk activities. So that's something, again, that's explicit, and I think it's a welcome change, because everyone is always afraid to do that, right? If there's an area of new risk, well, I can't touch anything that's already existing. I need to then just simply add resources and add staff. So now I can reallocate, and that's a welcome change.
So in the interest of time, I'm gonna pass on adding to this. Brian, if we could move forward. And,
okay. Yep, let's advance here to the results, and let's see what people have said. So easier is the most popular answer. Interesting.
Yeah, that's interesting. I was expecting people to say that it would be more complicated. Yeah, I'm looking at the time. Maybe we should move forward to the Bishi and Dan section, because we're running out of time now.
Yeah, I think just on this point, right? I think regulators are aware of the complexity as well as the challenges the financial institutions are getting. And again, I see a lot of questions coming up on the SAR and CTR, the thresholds and all. Unfortunately, I don't think we have enough time today, but in the last presentation, we kind of went into much more detail in terms of the SAR, CTR thresholds, what is the expectation from the regulatory side, as well as, from the law enforcement side as well. So probably, we can discuss that, probably in the next opportunity as well. So let's talk about in terms of the quantitative measures around the AML effectiveness, right? So if you look at from a historical perspective, probably it can be looked at as a pyramid structure, right? It can be looked at different lenses. So probably the regulators are sitting on the top, where they are primarily focused around the exam and the audit measures, where they're looking at the number of audit issues and the number of MRAs or MRAs still open, what is the remediation timeline the financial institution is taking. So those are the kind of metrics that the regulator would be interested, right? They also want to make sure that the financial institution is operating in a controlled manner, so that you're not risking to the overall the financial industry, right? The safeguarding of the financial industry, that's something they want to make sure. So next in the pyramid, if you come down one step down, I think we're talking about the top management of the financial institutions, right? they of course have to make sure that whatever the regulators are looking for, those things have taken into consideration. Along with that, they'll be also looking at what the overall cost of the program, right? How do we make sure that the customer frictions are addressed, right? Then the implementation of these laws and regulations are not creating a major barrier in terms of the customer expectations, as well as not impacting the overall business model. If you go to the next level, we are talking about the management, right? Who are kind of responsible for the day-to-day operation of the process. Again, they also have to make sure whatever the regulators are expecting, that's been taken care of, as well as whatever the top management is looking for, that also is taken care of. Along with that, they might be looking at the productivity, right? The number of SARs, the time to investigate, how much time we are spending for the case investigations. So those are the second metrics or the measurable metrics that the management would be looking for. Now, if you look at the guidelines from a regulatory perspective, this always has been a debatable topic, right? And there were not clear black and white expectations kind of published from the regulators, and this topic has been debated a number of years, right? And the regulators are actually aware of this lack of clarity as well. So in fact, in 2020 September, they come up with an advanced rulemaking process where at this process, I believe that's going through the feedback process, and we hope sometime in 2021, the final rule may come out from the regulators as well. If you look at that particular advanced rulemaking process, they're focusing primarily three core pillars of the core objectives, right? One is the assessment and the management of risk, right? Making sure that the financial institutions are adhering to the BSA requirements, as well as whatever information the financial institution actually sharing with the regulators have a high amount of usefulness to the government agencies, right? So these are three key pillars what this particular rulemaking is trying to address. And as I said, something that we are expecting, in 2021, the rulemaking process probably will be finalized on that one, on those steps. So again, quickly going to the process. If you look at from the regulatory perspective, I think the focus was around the number of exams, the severities of issues, and all, right? Now, if you look at the AML Act 2020, it obviously talks about the risk assessment. Again, I think Joe covered that in one of the slides previously. Risk assessment process probably is one of the processes where most of the financial institutions are already doing it. But there is a discussion in the Act that it might become a part of the AML program itself. So whether you are in financial institutions or not a financial institution, if you are required to have an AML program, probably risk assessment would be a part of your program as well. So you have to understand what's your risk and accordingly design your program so that it's kind of addresses various concerns, right? Similarly, there is a talk around the national priorities. I think every 2 years is going to publish the national priorities, and that is something is required to be probably integrated as part of the program as well. And it also talks about the periodic feedback, that the regulators are going to provide a periodic feedback, and they would require the financial institutions to make sure that the feedback that is coming through is actually being taken into consideration in terms of how the program is being updated as well as being monitored as well. Moving on, again, some other points around the reputational risk as well as the brand preservation. These are the other metrics both the regulators as well as the financial institution top management would be interested as well to make sure that the reputational risk is managed, right? I mean, again, historically it used to be a different story, but in today's world, the reputational risk and the preservation of the brand value is a very, very sensitive topic that every financial institution is kind of aware of, and they try their best to make sure it's been preserved as well. So moving on to the next, I believe, Dan, you have some thoughts around the cost measures and all.
Absolutely, Bishi. Thank you. I'm going to try to boil this down a bit because I know we're probably running short of time. When we discuss cost measures, many times the comparison can be made to banks within the same peer group. They may be asking, what are banks with a similar asset base spending on compliance? But where this tends to break down a bit is banks within the same peer group don't always have the same risk profiles. For example, you may have a bank that has an international focus and others only targeting clients in their footprint. but a third bank may be catering to MSBs, or we're hearing more about these days art and antiquities dealers. They may be striving for the same cost targets, but it's really an unreal expectation based on their really distinctly different risk profiles. So the cost measures we've outlined in this slide are just a starting point, and they may really need to be put into a broader context that I think we could probably spend a little bit more time on. But I wanted to give you a little bit of a flavor for that. But I do want to move on to the next slide and just make sure we can touch on some of the other points. The other thing I wanted to talk about for a minute is customer friction as it relates to effectiveness. And there's really this whole marketing versus compliance dilemma that I call it. And so really what this is based on is certainly marketing teams, they're doing a phenomenal job these days attracting new customers to banks, right? The marketing team themselves is measured on the number of accounts that they're able to open for a specific sales campaign. On the other hand, the compliance team is tasked with mission critical tasks like customer identification, know your customer, risk rating. Compliance team is less concerned with that frictionless onboarding experience. So working at a company like LexisNexis for the past 16 years, one of the things I've seen that I wanted to share is we may be helping a client set up an identity verification process, perhaps on other website for a new product offering. Many times the marketing team will advocate for the lowest identity verification settings and the highest risk, just to keep the number of accounts going through that process at a really high level. If the compliance team doesn't object, those rules will be implemented. So this has happened to me, more than one time over the years. If you fast forward 6 months from implementation, I'll get this frantic phone call from the compliance manager saying, hey, we need help designing a more sensible identity verification rule or rule set because we can't keep up with all these high-risk accounts that are being opened, which also serve to drive up their charge-off rates. So that certainly is that marketing versus compliance friction that we do see. Another thing I wanted to mention is this what I call pre-CIP dilemma, right? We have a lot of institutions that we work with that have had accounts on the books that predate Section 326 of the USA Patriot Act. Of course, Section 326 went into effect on October 1st of 2003. And these clients, our banking clients that have their own clients that predate Section 326, there's a reluctance to ask if they're missing information. Maybe they're missing a date of birth or they're missing some bit of information. There's a reluctance to ask and create friction to ask them for that missing information. So another thing we also see is maybe the institution has acquired a portfolio over the years. Or maybe they're acquiring a portfolio from a bank, and when they do a little bit of analysis, that bank has some fields that are missing that are required. It could be a date of birth, could be some other information. So many times as a compliance and technology partner, we will do one-time batches to help remediate that, to fill in that missing information. Sometimes our data is used to validate if a customer is prompted on your website to enter information. Our data will be used to confirm if that information is correct. So there's also that pre-CIP dilemma that we also help with, and from a friction perspective, we do offer quite a bit of assistance behind the scenes there as well. I just want to move forward to make sure we don't run out of time here as well. So on this, we want to spend a minute on operational metrics. So the AML Act has codified, as Joe said, a risk-based compliance program. We know the majority of the bank's resources should be spent on reviewing and monitoring highest risk activities. But from an employee satisfaction perspective, I think this is great. Monitoring higher risk activities will really be more interesting and satisfying to the employee. On the other hand, if employees spend a lot of time pulling reports, closing repetitive false positive alerts, that could lead to job burnout and higher turnover rates. So again, at LexisNexis, we're seeing a tremendous interest in things like robotic process automation, or RPA. Our clients are looking for ways to automate pulling of reports so their employees can focus on high-risk activities. We have seen such an interest in bots that at the end of the month, we're launching an environment exclusively for bots that not commingle the human users with bot users. We're really excited about that.